Now we will go to the next accounting standard, that is AS 7. This relates to construction contracts. As we know, construction activity is a different kind of business in a way, because most of the cases construction contracts take longer time to get over. For example, if a construction company is building a multi-storied building, it may take anywhere between 2 to 3 years. And in the meantime, how the construction company should account for the income, because only when the construction is complete can it be accounted as income. Is there any other way of accounting income? This is dealt with in the case of AS 7, that is mainly meant for construction contracts. This accounting standard prescribes the accounting treatment of revenue and costs associated with construction contracts. So here what they say is, it lays down guidelines regarding the allocation of contract revenue and the contract cost to the accounting period in which the construction work is performed, since the construction activity is generally contracted and completed in more than one accounting period. So since the entire activity takes place over, let us say, 3 accounting periods, how to account for income and expenditure for a particular accounting period? That means what portion of the total income needs to be taken for a particular accounting period, and what portion of the cost needs to be accounted in the case of costs for a particular accounting period. And not only this, an enterprise is required to disclose the amount of recognized contract revenue with the methods used to determine that revenue and the methods applied in determining the stages of completion of contracts in progress. That means, as per this accounting standard, they have to use one of the methods given in the accounting standard, and they also have to disclose as to what method they have used in recognizing the revenue for a particular accounting period, and what is the stage at which the completion of the contract is in. As per the standard, the gross amount due from and to customers for contract work are shown as assets and liability respectively. So whenever there is an amount due to the customers or from the customers, they are treated as assets and liabilities. That means they are the monies either owing to the company or owed by the company to the customers. AS 9 is an important accounting standard mainly concerned with revenue recognition. That means how to recognize revenue in the books of the entity. This becomes very, very important, because ultimately revenue recognition leads to the entity showing income in the form of actually recognized income, whether or not cash is received. So this deals with the basis for recognition of revenue arising in the ordinary course of business from the sale of goods or rendering of service, and income from interest, royalties and dividends in the profit and loss statement of an enterprise. Normally these are the different ways an entity earns revenue. One is revenue from its ordinary course of business. That means if it is in the manufacture of a particular product, the income will be from the sale of this product. If it is in the rendering of a particular service, income will be in the form of income generated out of rendering of the services. That is called the revenue from the ordinary course of business. Then it may also get some revenue from the sale of from interest or royalties and dividends if it has invested monies in other entities. So all these are also required to be recognized in the profit and loss statement of an entity. So what happens when an entity takes upon a lot of other activities such as construction contracts, hire purchase, lease agreements, government grants, etc. These are not covered under this. So what it says is, any revenue arising from such activities such as construction contracts, hire purchase, lease agreements, government grants and subsidies, and revenue from insurance companies, from insurance contracts, are outside the purview of AS 9. That means they are not dealt with in this particular accounting standard. For that there are separate accounting standards. As we have seen, AS 7 dealt with construction contracts, how to recognize revenue in the case of construction contracts. Similarly, we have separate accounting standards for lease agreements for government grants, etc. That we will be seeing later. So, as far as AS 9 is concerned, this standard requires that the entity should disclose the circumstances in which revenue recognition has been postponed pending the resolution of significant uncertainties. In certain cases, it is necessary that the recognition of revenue is postponed to the next accounting period or future accounting periods because of certain uncertainties involved in the recognition of that income. So, that needs to be disclosed properly in the financial statements. Then AS 10, that is accounting standard 10, is meant for accounting for fixed assets, how the fixed assets acquired by the entity are to be accounted for. Normally this deals with as to what should be the measurement of the cost of these fixed assets acquired by the company. So, this standard deals with the disclosure of the status of fixed assets in terms of value. The standard does not take into consideration the specialized aspect of accounting for a fixed asset reflected with the effect of price escalations, but applies to financial statements on historical cost basis. That means it is not concerned with what happens to the cost of an asset in terms of change in the price escalation, but only on the basis of historical cost. Once it is recognized on the basis of historical cost, what are the various items of cost that need to be incorporated in the total cost of the fixed assets. So, after this they have issued what is known as AS 26, that is accounting standard on intangible assets. So, whatever paragraphs which were contained in AS 10 dealing with intangible assets have been taken over in AS 26. So, those need to be ignored as far as AS 10 are concerned. And as far as AS 10 are concerned, the entity is required to disclose the following information. First is gross and net book values of fixed assets at beginning and end of an accounting period, showing additions, disposals, acquisitions and other movements. That means whatever gross value of the fixed assets the entity had at the beginning of the year has to be shown separately. To that they have to add whatever has been acquired during the year or whatever has been disposed of during the year, and from the total of all this they have to reduce the depreciation calculated by the method of depreciation adopted by the entity, and that will give the net value of the fixed assets as at the end of the accounting period. So, all these 4 columns need to be shown separately in the financial statements, so that the users of the financial statement are in a position to know as to what was the value of fixed assets at the beginning and what is the value at the end, and how the entity has dealt with these fixed assets during the course of the year. And it also deals with as to how to account for whatever expenditure is incurred on account of fixed assets in the course of construction or acquisition. That means, for example, let us say an entity is trying to install a machinery, and it may take several months to install the machinery, and during that installation process the entity may incur a lot of expenditure. How to account for this expenditure? Or the entity may have borrowed some money for the fixed assets, and until the entire machinery is installed it does not become operative. How to treat the cost of borrowing on that particular fixed asset till the time the asset is made available for use. All these are treated in this particular accounting for fixed assets. It also gives some kind of guidelines for treating the revaluation of the fixed assets. In case fixed assets are revalued, how the revaluation has to be accounted for, and how the revaluation reserve has to be shown in the financial statements of the entity. Then we come to the next accounting standard known as AS 11. This is on the effects of changes in foreign exchange rates. This came in a revised form in the year 2003 and was made applicable with effect from 1st April 2004. This particularly affects those entities which carry on activities involving foreign exchange in 2 ways. They would be either transacting in foreign currencies or indulging in foreign operations. That means they may have foreign operations or they may transact in foreign currencies. So, what this accounting standard says is, whenever there are foreign operations or whenever the entity deals in foreign currency transactions, all these transactions need to be expressed in the enterprise's reporting currency. What is the reporting currency? Reporting currency is the currency in which the entire financial statements are reported. For example, in the case of all Indian companies, they need to report the financial statements in the home currency of India, that is in rupees. So, that becomes the reporting currency. So, whatever reporting currency is there, they have to be stated in that particular currency. So, whatever transactions are there in some other currency, they need to be translated into the currency known as the reporting currency. And how this translation has to be done, what is the exchange rate which has to be taken into account, are dealt with under this. It also requires that the entity has to disclose certain matters. One is the amount of exchange differences included in the net profit or loss for the period. That means on account of change in the exchange rates, there could be some changes in the profit and loss of the entity. So, this has to be separately disclosed, because it is not an actual profit and loss, it is resulting on account of change in the exchange rates of the currency which has been converted into the reporting currency. Then the amount of exchange difference is adjusted in the carrying amount of fixed assets. In certain cases, whenever there is a change, the fixed assets themselves are adjusted. So, whatever is the amount adjusted there, that also has to be disclosed separately. Then the amount of exchange differences in respect of forward exchange contracts to be recognized in the profit and loss in one or more subsequent periods. So, even in case of foreign exchange contracts which are booked, there could be some exchange differences, and these also need to be separately disclosed in the profit and loss account. Now, we will go to another accounting standard known as AS 12. This is called accounting for government grants. Normally, different governments give different kinds of grants. In India, of course, most of the grants are given by the central government. In some cases, state government also may give grants. Grants are given for different purposes. Depending on the purpose, they need to be accounted for in the books of the entity. So, this standard specifies that the government grants should not be recognized until there is a reasonable assurance that the enterprise will comply with the condition attached to them and the grant will be received. So, there are two parts to it. Whenever a grant is announced by the government, the actual flow of money will not be there. The actual flow of money may be at a later stage. Secondly, government normally gives grants based on certain conditions which need to be fulfilled by the entity. They have to be complied with by the entity. So, only when the entity is able to comply with, will the entity be able to receive. So, if they want to recognize the grant in the books of the entity, they have to be certain that the entity is likely to comply with the terms and conditions laid down, and secondly, that there is a possibility that the money is likely to be received. If it is only on paper, if the grant is not going to be received, then there is no point in trying to recognize that as cash inflow in the books of the entity. The standard also describes the treatment of non-monetary government grants. That means government grants not in the form of money. Then the presentation of grants related to specific fixed assets. That means certain grants can be given for acquisition of certain fixed assets. That means conditional grants. And related, they could be related to revenue. They could be related to promoters' contribution. That means certain grants they get provided relators have brought in their own contribution of a certain percentage of the total cost, and treatment for refund of government grants, etc. So, all these have to be looked into, because there may be clauses for refund of government grant if the entity does not comply with certain conditions. So, all these need to be looked into, and this standard provides for the treatment of all such eventualities. The standard also wants the entity to disclose certain things in the financial statements. One is the accounting policy adopted for government grants, including the methods of presentation in the financial statement. It means whatever policy the entity has adopted in recognizing revenue from the government grants has to be disclosed, and they also have to disclose the nature and extent of government grants recognized in the financial statements, including non-monetary grants of assets given at a concessional rate or free of cost. Even all those things which are non-monetary in nature also need to be included in the financial statement. They need to be disclosed also for the users of the financial statements. Then AS 13 deals with accounting for investments. As we know, lot of entities also would be investing part of their funds in investment, and particularly this is true of banks. Banks have a large portfolio in the form of investments. Whatever money they have, in addition to lending for different activities, they also invest in the stock market, they invest in government security, they invest in other things such as mutual funds. So, how to account for these investments is given in this standard called AS 13. This standard deals with accounting for investments in the financial statements of enterprises and related disclosure requirements. So, there are two parts here. One is how to account for investments. Second is what kind of disclosures are required to be made. Both have to be dealt with by the entity. So, as per this standard, investment need to be classified as current investments and long term investments. So, it calls for two types of classification, one in the form of current investments, the other is called long term investments. As the name suggests, current investments are those realizable in nature and intended to be held for not more than 1 year from the date of the acquisition. The idea is the entity has made this investment with an intention to trade in them or sell them within a period of 1 year. So, such investments are treated as current investments, and long term investments are those which are not treated as current investment. That means they are acquired with the object of holding them for longer periods, and they are not intended to be liquidated within a period of 1 year. So, the entity is required to disclose both the quantum of current investments and long term investments separately in their financial statements. An investment property should be accounted for as long term investment. Any investment in the property should be always treated as a long term investment. The cost of investment should include all acquisition costs, including brokerage fees and duties. That means, suppose an entity is acquired, let us say land, building, whatever money they have paid for acquisition of that land, either in the form of payment of fees to brokers or payment of stamp duties, registration fees, etc., all these need to be included as acquisition costs and accounted as such. And once the investments are disposed of, the difference between the carrying amount and net disposal proceeds should be charged or credited to profit and loss account. That means, if there is a gain on account of disposal of these investments, they have to be credited to the profit and loss account. If there is a shortfall, they have to be debited to the profit and loss account. That means, they have to be shown in the profit and loss statement. Now, we will go to accounting standard 14, that is accounting for amalgamations. As we know, amalgamations normally referred to as mergers and acquisitions in normal day usage. So, this standard deals with the accounting treatment for such amalgamations, and normally whenever there is an amalgamation, there is a question of goodwill or reserve. That means, normally the company which is acquiring another company may have to pay some money in excess of what is there in the form of assets of the company, net assets of the company. So, that is treated as goodwill, or they may acquire at a lesser value also. So, all these need to be accounted for in the books of the entity which has acquired the other company. So, there they talk of two kinds of amalgamations. One is amalgamation in the nature of merger or in the nature of purchase. So, it can be either a purchase or a merger. So, if it is an amalgamation in the nature of merger, only if it satisfies certain conditions laid down in the accounting standard. We will not go into the details of that, but normally an amalgamation in the nature of merger is when the promoters or the shareholders of the entity being merged normally become the shareholders of the entity with which it is merged. That means they continue in the business as shareholders of the merged entity. And there are a lot of other conditions attached. If all those conditions are fulfilled, then such an amalgamation is treated as a merger, as an amalgamation in the nature of merger. If even one of the conditions is not fulfilled, then such a amalgamation is treated as an amalgamation in the nature of purchase. And the accounting standard provides for different accounting treatments in respect of amalgamation in the nature of merger as well as amalgamation in the nature of purchase. And it also prescribes certain disclosure requirements for both types of amalgamations. AS 15 is an accounting standard for treatment of employee benefits. What are employee benefits? Employee benefits are benefits given to the employees. They could be in the form of short-term employee benefits such as wages, salaries, etc., which are paid on a monthly basis. They could be post-employment benefits, that is paid on retirement or on termination, such as gratuity, pension, etc. They could be long-term employee benefits such as long-term leave, long-term disability benefits, or they could be termination benefits such as VRS payments. So the standard AS 15 lays down different recognition and measurement criteria and disclosure requirement for all the 4 types of employee benefits discussed above as to how they have to be accounted for. For example, let us say a company has a practice of giving a benefit of, let us say, leave encashment to the employees. Normally this leave encashment may not be exercised by the employee in any year, but that is a benefit which has to be given by the entity. So since it is a cost involved for the entity, it needs to account for this on a yearly basis. Every accounting period, whether or not actually paid, this cost needs to be accounted for. So AS 15 goes into the details of this and gives an idea as to how all these benefits need to be accounted in the books of the entity. AS 16 goes on to talk about borrowing costs. Whenever an entity borrows, it incurs costs such as interest cost and other costs, and these need to be accounted for in the books of the entity. So this accounting standard deals with issues related to identification of asset which qualifies for capitalization of interest, determination of the period for which interest can be capitalized, and determination of the amount that can be capitalized. So what basically it means is, let us take an example. Let us say a company has borrowed money for purchase of a machinery, and machinery may take at least, let us say, 6 months for being bought and installed in the factory and made ready for use. So during this period of 6 months, the company will be paying interest on the funds borrowed for the acquisition of that machinery. And what this accounting standard says is, such interest which is incurred before the machinery is actually put to use can be capitalized. What is the meaning of capitalization? Capitalization means that the money can be treated as a historical cost and treated as part of the total cost of the asset. So borrowing costs can be capitalized subject to certain conditions which are laid down in this accounting standard. What it says is, whatever costs are incurred, including borrowing costs, up to the date the asset is put to use, can be capitalized. That means all interest expenses leading to that particular asset can be capitalized up to the date when the asset becomes ready for use. And such costs are not treated as expenditure for that particular accounting period. All other costs are treated as expense in the period in which they are incurred. That means any interest paid on account of the machinery after the date the machinery is put to use is treated as an expense, because that cannot be capitalized. Then we go to accounting standard 17, known as segment reporting. As we know, each entity may be active in many of the segments in which it is working, and this particular standard wants that the entity should disclose information based on the segment. so as to give an idea to the users of the financial statement as to what are the nature of activities segment wise. For example, the entity may have different types of products and services, they may be operating in different geographical areas. So, entity has to classify as to what are the different types of segments in which it is operating. For example, let us say we take the case of a bank, let us say State Bank of India has got domestic operations as well as international operations. So, their segmentation can be one on account of domestic operations, one on account of international operations. Similarly, an entity, a manufacturing entity can be operating both in India as well as in foreign countries. So, the segment could be Indian operations and the foreign operations, or it could be in terms of different products. For a multi-product company, it could be in terms of different products. So, this kind of segmentation has to be done by the entity depending on the nature and type of business handled by that business. Once that is done, they have to assess the risk and returns of such segments, and this data needs to be disclosed in the AS 17. So, segment reporting becomes very important for the users of the financial statement, so that they will be able to relate the different segments as to their risk and return characteristics. We will go to AS 18, meant for related party disclosures. This is again a very important accounting standard. Related party is what? A related party is a party which is related to the enterprise and is having dealings with the enterprise. For example, if an entity is related to the promoters of the company or the board of directors of the company, or to any shareholder who has got a substantial interest in the management of the company, such parties are known as related parties. To give an example, let us say a company is giving a contract to a firm, and the partner of the firm has got substantial holding in the company, then that firm becomes a related party. And whenever there are dealings of the entity with related parties, they need to disclose such dealings. What is the reason? The objective is that there should not be any conflict of interest between the parties and the entity, and if there is any conflict, it needs to be disclosed to the shareholders. So, these accounting standards laid down certain disclosures which must be made in the financial statements of reporting enterprise for transactions between the reporting enterprise and its related parties. Whatever transactions are there, they could be in the form of sales, purchases, they could be in the form of other service contracts. All these need to be disclosed. The disclosures apply both to the standalone financial statement and the consolidated financial statement. That means even when the company does not have any subsidiaries, they have to be disclosed separately, and even in the case of group companies, they need to be disclosed. That means whatever transactions take place between the related parties, between one group company and another group company, or between the companies and the other outside related parties, need to be disclosed both in the financial statement of the parent company or the subsidiary company individually, but also in the consolidated financial statement of the parent company, which includes the financial statement of the subsidiary company also. And the standard also defines what is the meaning of a related party. That means as to who is treated as a relative party, what is the meaning of substantial interest in the company. So, what should be the percentage of shareholding of a person to call for that categorization of substantial interest.